Hello and welcome. Before we begin, I need to say something important. Everything you're about to hear today is general information only. It is not personal financial advice. Your situation is unique. Always speak with a licensed financial advisor before making any major decisions about property or money. Now, let's talk about something that's been weighing on your mind. You're watching your children struggle, or maybe your grandchildren. They're working full-time jobs, good jobs, yet they can't seem to get a foothold in the property market. And you remember when things were different. You remember when a young couple could save for a year or two and put down a deposit. You remember when a home didn't cost 10 times the average wage. And here's what really keeps you up at night. You want to help them. You've worked hard your whole life. You've saved. You've been careful. But you're also worried. Worried about whether you have enough for your own retirement. Worried about making a mistake that could cost your family dearly. Worried about giving advice in a market you barely recognize anymore. This isn't just about property prices. This is about family. This is about legacy. This is about wanting to see the people you love have the same opportunities you had, and feeling frustrated that the rules have changed so dramatically. Maybe you're thinking about helping with a deposit. Maybe you're considering going guarantor on a loan. Maybe you've even thought about purchasing an investment property that your kids could eventually buy from you. But every option feels risky. Every choice feels like it could go wrong. And the worst part? The financial advice you read online seems written for 30-year-olds with high-risk appetites, not for you. Not for someone who needs to protect what they've built while still wanting to help the next generation. I see you. I hear you. And today, we're going to walk through this together. We're going to look at which Australian cities actually make sense for first home buyers in 2026. Not from the perspective of a property speculator, not from the view of someone chasing capital growth at any cost, but from the perspective of someone who wants safety, affordability, and a genuine place to call home. Because here's the truth, not every city is suitable for every buyer, and understanding which locations offer the best combination of affordability, livability, and future security is absolutely critical, especially if you're thinking about helping your children or grandchildren take this step. So take a deep breath, you're in the right place. And by the end of our time together today, you'll have a clear framework for thinking about this decision. Let's start by going back in time. Think about when you bought your first home. For many of you, that was probably in the 1970s or 80s, maybe the early 90s. Do you remember the price? I'm willing to bet it was somewhere between 3 to 5 times the average household income. Maybe a bit more in Sydney or Melbourne, but it was achievable. A young couple could save 10 or 15% deposit in a couple of years if they were disciplined. The average Australian home in 1980 cost around $67,000. The average wage was around $13,000. That's about a 5-to-1 ratio. Tough, but doable. Now let's look at today. The median house price across Australia sits well over $700,000. In Sydney, it's over $1 million. In Melbourne, it's approaching that figure. And the average wage? Around $90,000 for a full-time worker. That's a ratio of 8-to-1 nationally. In our major capital cities, it's often 12-to-1 or higher. The gap has exploded. And it's not because young people today are less disciplined. It's not because they're buying too many flat whites, despite what some newspaper columns might tell you. It's because the fundamental economics of housing in Australia have shifted. What changed? Several things happened at once. First, interest rates fell dramatically from the 1990s onward. Lower rates meant people could borrow more. When people can borrow more, they bid up prices. That's basic economics. Second, we had massive population growth, especially in Sydney and Melbourne. More people competing for housing in the same areas. Again, prices rise. Third, we saw the rise of property investment as a wealth-building strategy. Negative gearing and capital gains tax concessions made property attractive to investors. More investors in the market meant more competition for the same pool of homes. Fourth, wages stopped keeping pace with productivity. The link between how hard Australians worked and how much they earned began to weaken in the 2000s. Meanwhile, the cost of essentials, especially housing, kept climbing. And fifth, we simply didn't build enough housing in the right locations. Planning restrictions, NIMBY politics, infrastructure limitations, all of it meant supply couldn't keep up with demand in our major cities. So here we are in 2026. Young Australians face the most challenging property market in our nation's history. That's not an exaggeration, that's the data speaking. But here's where it gets interesting. Not every Australian city faces the same challenge. Yes, Sydney and Melbourne are extraordinarily expensive, but Australia is a big country, and there are cities where the dream of home ownership is still very much alive. The question is, which ones? And more importantly, which ones make sense for your children or grandchildren, considering their career prospects, lifestyle needs, and long-term security? That's what we need to explore together. Now, before we dive into specific cities, we need to understand what makes a location genuinely suitable for first home buyers, because cheapest doesn't always mean best, and expensive doesn't always mean bad value. There are 6 key factors we need to consider. Factor 1 is the price-to-income ratio. This is the median house price divided by the median household income. Ideally, we want this to be 6 or below. When it creeps above 8, home ownership becomes extremely difficult without significant help. Factor 2 is employment opportunities. A cheap house means nothing if there's no work. We need to look at cities with diverse economies, low unemployment, and growing job markets, particularly in industries that are future-focused. Factor 3 is infrastructure and livability. Does the city have good hospitals, quality schools, public transport, parks and recreation, cultural amenities? These things matter enormously for quality of life, and they matter even more if you're thinking long-term about where your grandchildren might grow up. Factor 4 is supply and demand dynamics. Is new housing being built? Is population growing faster than construction? Are there physical constraints limiting growth, like geography or planning restrictions? Understanding these dynamics helps predict whether prices are likely to remain stable or continue rising rapidly. Factor 5 is rental yields. Even if your children plan to live in the property, understanding rental yields tells you about affordability relative to incomes in that city. It also provides a safety net. If circumstances change and they need to rent it out, a decent yield makes that viable. And factor 6 is future growth prospects. Not wild speculation, but sensible assessment. Is the city investing in infrastructure? Are new industries coming? Is government policy supporting growth? These indicators help assess whether the city has a sustainable future. Now, armed with these 6 factors, let's look at the Australian property landscape in 2026. Let's start with where not to look, and I'm going to be direct here. Sydney is extraordinarily difficult for first home buyers. The median house price is well over $1 million. Even units are approaching $700,000 in many areas. The price-to-income ratio is above 12 in most suburbs. Unless your children have very high incomes, substantial savings, or significant family help, Sydney is largely out of reach. I'm not saying it's impossible. I'm saying it requires resources that most young Australians simply don't have. Melbourne is similarly challenging. While slightly more affordable than Sydney, the median house price still exceeds $900,000 in many areas. The price-to-income ratio sits around 10, and Melbourne has the added complication of having overbuilt apartments in the CBD during the 2010s, leading to quality concerns in some developments. Does this mean Sydney and Melbourne are off the table entirely? Not necessarily. If your children already live there, have established careers there, and are willing to look at outer suburbs or sacrifice space for location, it might still work. But we need to be realistic about the challenges. So where should we look? Let's start with Brisbane. Brisbane has been receiving enormous attention over the past few years. The 2032 Olympics were announced, interstate migration from Sydney and Melbourne accelerated, and prices rose significantly. But here's the interesting thing. Despite that growth, Brisbane remains more affordable than Sydney or Melbourne by a considerable margin. The median house price in Brisbane sits around $750,000. Still expensive, certainly, but the price-to-income ratio is closer to 8. That's high, but manageable for dual-income households with some savings. Brisbane offers genuine employment opportunities. The economy is diversifying beyond its traditional base. Technology sector is growing, health and education are strong, government services provide stability, and the city is investing heavily in infrastructure. The Cross River Rail project will transform public transport. Olympic preparations mean billions in infrastructure spending over the coming years. The lifestyle is appealing. Subtropical climate, outdoor living, generally lower cost of living than Sydney or Melbourne for day-to-day expenses, and you can still find three-bedroom houses in decent suburbs within 30 to 40 kilometers of the CBD. The risk with Brisbane? The market has already run hard. If you're buying now, you're not getting in early. You're buying after significant growth has already occurred. That doesn't mean it's a bad decision, but it means your children shouldn't expect the same rapid capital growth that early buyers enjoyed. They're buying for a home and lifestyle, not as a speculative investment, and that's actually fine. Now let's talk about Adelaide. Adelaide is perhaps the most underrated city in Australia for first home buyers right now. The median house price in Adelaide sits around $650,000. The price-to-income ratio is around 7. That's getting into genuinely affordable territory compared to the East Coast capitals. Adelaide offers solid employment, particularly in defense, advanced manufacturing, health, and education. The city has attracted significant investment in these sectors. The economy is stable, if not spectacular. Infrastructure is good. The city is compact. You can live 20 kilometers from the CBD and still have a reasonable commute. Public transport is adequate, schools are good, hospitals are excellent, and the lifestyle is family-friendly. Adelaide also has something else going for it. The South Australian government has been actively trying to attract interstate migration. They've offered incentives, they've marketed the lifestyle, and it's working. Population growth is steady, which supports housing demand without creating the price explosions we've seen in Brisbane. The challenge with Adelaide? It's not as economically dynamic as Brisbane or Perth. Job opportunities are more limited, particularly in certain industries. If your children work in finance or technology, their options are more restricted. But if they're in health, education, government, or trades, Adelaide offers genuine opportunities. And here's something important. Adelaide allows first home buyers to establish themselves in the market. They can buy a proper house with a yard in a decent suburb without crushing themselves financially. That matters enormously for quality of life and long-term financial security. Perth deserves serious consideration. Perth went through a brutal downturn after the mining boom ended. Prices fell, people left, the city struggled. But something interesting has happened over the past few years. Perth has recovered, and it's recovered in a healthy way. The median house price in Perth sits around $600,000. The price-to-income ratio is around 6.5. That's actually approaching historical norms. That's what affordability used to look like across Australia. Perth's economy has diversified. Yes, mining is still important, but health, education, technology, and professional services have all grown. Unemployment is low. Wages are competitive, particularly in certain sectors. And Perth offers something unique: space, real space. You can buy a 4-bedroom house with a proper backyard, a pool, and a double garage for prices that wouldn't get you a 2-bedroom unit in Sydney. For young families, that space matters. The infrastructure is good. The beaches are spectacular, the climate is fantastic, and the city is investing in public transport with the airport rail link finally under construction. The risk with Perth? It's isolated, very isolated. If your children value being close to family on the East Coast, Perth is a 4-hour flight away. That's not trivial. And the economy, while more diverse than before, is still connected to resources. When commodities do well, Perth booms. When they don't, Perth struggles. But for the right buyer, particularly someone who values lifestyle and affordability over being in a major East Coast capital, Perth is absolutely worth considering. Now let's talk about some smaller cities that often get overlooked. Hobart experienced a property boom over the past decade that surprised many people. Prices roughly doubled. The median house price now sits around $700,000. That's expensive for a city of Hobart's size and economic base. The price-to-income ratio has climbed above 8. The challenge with Hobart is that it's a small market, limited employment opportunities outside government, education, and tourism. Population is small, which means less economic diversity, and the boom has already happened. You're buying after the growth, not before it. That said, Hobart offers lifestyle, natural beauty, culture, a strong sense of community. If your children can work remotely or have specialized skills in demand there, it could work, but it's not the affordability play it was a decade ago. Canberra is interesting. The median house price exceeds $800,000, expensive. But here's the thing, Canberra has the highest median household income in Australia. Government workers are well paid. The price-to-income ratio, while high, is somewhat offset by higher incomes. Canberra offers incredible job security. The public service isn't going anywhere. Education and health sectors are strong. Unemployment is consistently among the lowest in the nation. The lifestyle is family-friendly, great schools, low crime, excellent infrastructure, and you're only 3 hours from Sydney or a few hours from the snow. The challenge? Canberra can feel small and insular. It lacks the vibrancy of Melbourne or Sydney. Career opportunities outside government and related sectors are limited, and the market is somewhat artificial, being driven primarily by public sector wages rather than diverse economic activity. Now, what about regional Australia? This is where things get really interesting. Regional cities like Geelong, Newcastle, Wollongong, the Sunshine Coast, and the Gold Coast offer a middle ground. They're close enough to major capitals to access some opportunities while being significantly more affordable. Geelong, for example, has a median house price around $650,000. It's an hour from Melbourne. It has its own economy based on advanced manufacturing, education, and health. The lifestyle is excellent, and you're not completely cut off from Melbourne's opportunities. Newcastle is similar. Median around $700,000, 2 hours from Sydney, strong economy based on education, health, and services, beautiful beaches, growing cultural scene. The Sunshine Coast and Gold Coast offer Queensland lifestyle at a discount to Brisbane. Both have median prices around $700,000. Both offer employment, particularly in tourism, health, construction, and increasingly remote work-friendly industries. The pattern here is clear. Regional cities close to capitals offer affordability while maintaining access to opportunities. They're not for everyone. If your children need to be in the thick of a major city for career reasons, regional won't work. But for many people, particularly those who can work remotely or flexibly, regional cities offer the best of both worlds. Let me introduce you to Bruce and Jenny. They're not real people, but they represent a very real situation. Bruce and Jenny are in their early 60s. They live in Sydney. They have 2 adult children, Michael and Sarah. Michael is 32. He's an accountant. He earns $90,000 a year. His partner, Lisa, is a teacher. She earns $80,000. Together, they're on $170,000. Good income. But they've been renting in Sydney for 8 years. They've saved $80,000, and they're completely priced out of Sydney's market. Sarah is 29. She's a nurse. She earns $75,000. She's single. She saved $50,000. She also can't afford Sydney. Bruce and Jenny have $800,000 in superannuation combined. They own their home in Sydney, worth about $1.2 million, and they desperately want to help their children. They came to me asking what they should do. Should they refinance their home to help with deposits? Should they go guarantor? Should they buy investment properties for the kids? Here's what we explored together. First, we looked at whether Michael and Lisa really needed to stay in Sydney. Michael's accounting skills are portable. He could work anywhere. Lisa's teaching qualification is recognized Australia-wide. After some discussion, they were open to relocating if it meant home ownership. We looked at Brisbane, Adelaide, and Perth. We ran the numbers. In Adelaide, they could buy a 3-bedroom house in a good suburb for $650,000. With their $80,000 deposit, they'd need to borrow $570,000. On their combined income, that's manageable. The mortgage would be around $3,000 a month. Tight, but doable. Compare that to Sydney. Even in outer suburbs, they'd need to borrow at least $800,000 for anything livable. The mortgage would be around $5,000 a month, unaffordable without help. Bruce and Jenny agreed to help with an additional $50,000 for the Adelaide purchase. Not a loan, a gift. This brought Michael and Lisa's deposit to $130,000, 20%. No lender's mortgage insurance, lower borrowing, and genuine financial security. Michael and Lisa moved to Adelaide. Michael found work with a mid-sized accounting firm. Lisa got a teaching position. They bought their home, and critically, they're not financially stressed. They can save. They can enjoy life. They can think about starting a family without being crushed by debt. Now, Sarah's situation was different. She's single, lower income, but she loves nursing and wants to stay in healthcare. We looked at regional New South Wales, Newcastle specifically, strong health sector because of the major hospital, median house prices around $700,000, but units available for under $500,000. Sarah bought a 2-bedroom unit for $450,000. With her $50,000 deposit and another $30,000 gift from Bruce and Jenny, she put down $80,000, borrowed $370,000, mortgage about $2,000 a month, manageable on her salary. She's close enough to Sydney to visit family every month or two, she's in a proper city with amenities and culture, and she owns her home. Bruce and Jenny helped their children with a total of $80,000. That's 10% of their net wealth. Significant, but not catastrophic. They didn't refinance their home, they didn't go guarantor, they didn't expose themselves to risk. They simply gave their children deposits and helped them find cities where home ownership was achievable. Both Michael and Sarah are now building equity. Both have security. Both can build their lives without the crushing anxiety of unaffordable rent or impossible home ownership. This is what smart family assistance looks like. It's not about throwing money at an unaffordable market. It's about helping your children find markets where their money actually works. Now let's talk about what you can actually do, whether you're helping children, grandchildren, or simply trying to understand the landscape. Here are the practical steps you can take. Step 1 is research employment prospects. Before considering any city, look at job opportunities. Visit Seek or Indeed. Search for positions in your children's field. Are there roles? What do they pay? How many openings are there? This tells you whether a city can actually support their career. Step 2 is understand the numbers properly. Look up the median house price for the city. Look up median household income. Calculate the ratio. If it's above 8, be cautious. If it's above 10, be very cautious. Unless there are specific circumstances, markets with ratios above 10 are difficult without substantial help. Step 3 is visit the city. Don't make decisions based on statistics alone. Spend a weekend there. Drive around suburbs. Visit shopping centers. Check out schools and parks. Talk to locals. Get a feel for whether your children could actually build a life there. Step 4 is work with a mortgage broker early. Before making any commitments, understand borrowing capacity. Mortgage brokers can give accurate assessments based on income, expenses, and deposit. This prevents heartbreak later when you discover something isn't actually affordable. Step 5 is understand the first home owner grant and stamp duty concessions. Every state has different schemes. Some offer grants, some offer stamp duty exemptions or reductions. These can save tens of thousands of dollars. But the rules are complex and change regularly. Don't assume. Research the current schemes for the specific state you're considering. Step 6 is consider the guarantor option carefully. Going guarantor means you're using equity in your home to help your children avoid lender's mortgage insurance. It can be helpful, but understand the risk. If your children can't make repayments, you're liable. Your home is security. Only do this if you're completely confident in their financial stability and have a clear exit plan for releasing the guarantee within a few years. Step 7 is think about gifting versus lending. If you're helping with a deposit, are you gifting the money or lending it? Be clear. Put it in writing. If it's a gift, say so explicitly. If it's a loan, document the terms. Confusion here destroys families. Don't let money ruin relationships. Step 8 is protect your own retirement first. This is critical. You cannot help your children if you compromise your own financial security. Before giving or lending any money, make absolutely certain you have enough for your retirement. Run the numbers. Talk to a financial advisor. Your children would rather rent for a few more years than see you struggle in retirement. Step 9 is avoid the investment property trap. Some parents think buying an investment property for their children to rent is a good solution. Be very careful. Investment properties come with landlord obligations, maintenance costs, potential vacancy, and if you're negatively geared, you're subsidizing the property from your retirement savings. It can work in specific circumstances, but it's complex and risky. Get advice before going down this path. And step 10 is communicate openly with your family. Talk about expectations. Talk about what you can and cannot do. Talk about what help looks like. Transparency prevents resentment. It prevents misunderstanding, and it keeps families strong. Now, let me give you a framework for actually making a decision about which city makes sense. Create a simple scorecard. List the cities you're considering across the top. List your criteria down the side: affordability, employment, lifestyle, infrastructure, future prospects, family proximity, climate, whatever matters to your specific situation. Rate each city out of 10 for each criterion. Be honest, be realistic. Then weight the criteria. If employment is absolutely critical, give it double weight. If family proximity matters enormously, weight it higher. If climate is nice but not essential, weight it lower. Calculate the scores. The city with the highest weighted score is your starting point, not your final answer, your starting point for deeper investigation. This process stops you from making emotional decisions. It forces you to think clearly about priorities, and it gives you a framework for discussion with your family. Let me also address some common myths that might be clouding your thinking. Myth 1 is that you must buy in a capital city. Not true. Regional cities and large towns can offer excellent opportunities, particularly if employment is secure. Don't dismiss them out of prejudice. Myth 2 is that property always goes up. Not true. Property in some locations stagnates or even falls for extended periods. Perth fell for years after the mining boom. Some regional towns have never recovered from industry closures. Property in the right location at the right price tends to perform well over long periods, but property anywhere at any price does not. Myth 3 is that you should buy the worst house in the best suburb. This old advice doesn't work in today's market. Renovation costs are astronomical, and in expensive suburbs, even the worst house is often still overpriced. Better advice is to buy a good house in an emerging suburb with solid fundamentals. Myth 4 is that first home buyers should always buy apartments to get into the market. Sometimes true, but be cautious. Apartments face body corporate fees, sinking funds, and potential structural issues. And in oversupplied markets like parts of Melbourne, apartment values have stagnated while houses have grown. Each situation is different. Myth 5 is that you need a 20% deposit. Helpful because it avoids lenders' mortgage insurance, but not essential. Lenders' mortgage insurance is a cost, typically 1 to 3% of the loan. Sometimes it makes sense to pay it and buy sooner rather than saving for years while prices rise. Run the numbers for your specific situation. And myth 6 is that interest rates will stay low forever. Dangerous thinking. Rates are higher now than they were a few years ago. They could go higher still. Always calculate whether your children could afford repayments if rates rose by 2%. If they can't, they're borrowing too much. Now I want to talk about timing. When is the right time to buy? The honest answer is that no one can predict the property market perfectly. People who claim they can are either lying or deluded. But we can think about principles. Principle 1 is that time in the market beats timing the market. If your children find the right property in the right city at a price they can genuinely afford, buying sooner is usually better than waiting. Even if prices fall slightly in the short term, over 10 or 15 years, being in the market builds equity and security. Principle 2 is that waiting for the perfect moment often missing opportunities. The market might fall, it might not, but life moves on. Rent keeps being paid. Children grow older. Opportunities shift. Paralysis is its own form of risk. Principle 3 is that personal circumstances matter more than market conditions. If your children are in stable employment, have a deposit, can afford repayments comfortably, and have found a city and property that suits their needs, that's enough. You don't need the market to be at the bottom. You need their situation to be right. Principle 4 is to avoid buying in obvious bubbles. If everyone is talking about how a particular city is booming and you must get in now or miss out forever, be skeptical. That's usually a sign you're late. Brisbane in 2021 and 2022 had those characteristics. Some people who bought then are doing fine, but they bought after the surge, not before it. And principle 5 is that buying a home is not the same as buying an investment. If your children are buying to live in, they're buying shelter, security, and a foundation for their life. That has value beyond capital growth. Don't let fear of poor market timing prevent them from building that foundation if they're otherwise ready. Let me now talk about something we haven't touched on yet. What if your children simply cannot afford to buy anywhere, even in the most affordable cities? This is a real possibility for some people. If your children are in lower-income jobs, have debt, or are single-income households, even Adelaide or Perth might be out of reach. In that case, we need to think differently. Renting is not failure. Renting provides flexibility. It allows people to live in locations they couldn't afford to buy. It frees up capital for other investments. The Australian cultural obsession with homeownership is strong, but it's not the only path to financial security. If your children are long-term renters, focus on helping them build wealth in other ways: superannuation, shares, managed funds. Building wealth doesn't require owning property. Also consider that circumstances change. Income grows, partnerships form, inheritance happens. What's unaffordable today might be achievable in 5 years. Don't give up hope, but also don't wait for homeownership to start building financial security. And remember, your role as a parent or grandparent is not to solve everything. It's to provide guidance, support, and love. Whether your children own or rent, what matters is that they're building good lives. Property ownership is a means to an end, not the end itself. Now let's bring this back to you personally. What should you be thinking about as someone in or approaching retirement? First, recognize that helping your children is a choice, not an obligation. You have worked hard. You have earned your financial security. Do not let guilt or pressure compromise your retirement. If you can help comfortably, wonderful. If you cannot, that is also completely acceptable. Second, understand that the best help is often guidance rather than money. Helping your children understand which cities make sense, how to budget, how to research employment, how to work with mortgage brokers, these things have enormous value, and they cost you nothing. Third, if you do provide financial help, make sure it fits within your broader retirement and estate plan. Talk to your financial advisor. Make sure any gifts are fair across all your children. Make sure you're not creating tax issues or affecting your pension eligibility if you're receiving Centrelink. Fourth, consider your own property situation. If you're in Sydney or Melbourne in a large family home you no longer need, downsizing might release equity. This could fund both your retirement and provide help to children. But don't downsize purely to give money away. Downsize if it makes sense for your lifestyle and finances first. And fifth, remember that you can provide different types of support. Maybe you can't help financially, but maybe you can provide childcare while your children save. Maybe you can offer a room in your home temporarily while they build their deposit. Maybe you can share your own financial knowledge and discipline. Support comes in many forms. Let me tell you about another couple, Frank and Margaret. They're 70. They have 3 children, all in their 40s now, all struggling with property in Sydney. Frank and Margaret don't have substantial savings. Their wealth is tied up in their home, worth about $1 million. They receive a part-age pension. They can't help financially, but here's what they did. They sat down with each child and helped them create proper budgets. They asked hard questions about spending. They helped them see where money was leaking. They provided accountability. They also helped research regional areas. They spent weekends driving to different towns with their children, looking at communities, talking to real estate agents, building knowledge. One child ended up buying in Bathurst, another in Port Macquarie. The third is still renting but saving faster with the budget discipline Frank and Margaret helped instill. Frank and Margaret gave their children time, wisdom, and support, not money, and their children are genuinely grateful. Sometimes that's the most valuable gift of all. As we start to bring this conversation to a close, I want to zoom out and think about the bigger picture. Australia faces a genuine housing affordability crisis. This is not your children's fault. It's not your fault. It's the result of decades of policy decisions, economic shifts, and demographic changes. Recognizing this helps remove the guilt and shame that many young people feel about struggling with home ownership. But despite this crisis, opportunities exist. They're not in the same places they used to be. They require different thinking. They require flexibility, but they exist. Brisbane, Adelaide, Perth, and regional cities near capitals offer genuine pathways to home ownership for people willing to think differently about where they live. The key is matching the city to the individual. There's no one right answer. A city that's perfect for a nurse who values lifestyle might be terrible for a software developer who needs proximity to a tech hub. A city that works for a couple with remote work flexibility might be impossible for someone in a location-specific career. This is why the research matters. This is why visiting matters. This is why honest conversation about priorities and trade-offs matters. And for you, as someone who cares deeply about your family's future, your role is to help facilitate that thinking, to provide perspective, to share wisdom, and to support whatever path your children choose, whether that's buying in Adelaide, renting in Sydney, or something else entirely. Your generation had opportunities that this generation doesn't. That's simply a fact. But this generation has opportunities your generation didn't. Mobility, technology, access to information, different career paths. The world has changed in many ways. What hasn't changed is the human need for security, for home, for family, for purpose. These things matter regardless of whether someone owns or rents. These things matter regardless of which city someone lives in. So as you think about how to help your children or grandchildren navigate this property market, remember the bigger picture. You're not just helping them buy a house, you're helping them build a foundation for a good life. And that foundation is built on financial security, yes, but also on relationships, on purpose, on health, on community. Make decisions that honor all of those things. Don't sacrifice your retirement for a property deposit. Don't push your children toward a city that's wrong for them just because it's affordable. Don't let the stress of this market damage your family relationships. Instead, approach this with wisdom, patience, and love. Do your research, have honest conversations, and make decisions based on sound principles rather than fear or emotion. And trust that if you do this, the right path will become clear. You've lived through economic ups and downs. You've seen property markets rise and fall. You've built a life. You have perspective that your children don't yet have. Use that perspective, share it, but also listen to their needs and dreams. This is your third act, the phase of life where you get to enjoy the fruits of your labor, yes, but also where you get to be a source of wisdom and support for the people coming after you. That's a beautiful role, a meaningful role. And part of that role in 2026 is helping the next generation navigate a property market that looks nothing like the one you entered decades ago. Some of them will buy in Brisbane, some in Adelaide or Perth, some in regional cities. Some won't buy at all, and that's okay too. What matters is that they make informed decisions, that they don't crush themselves financially chasing an impossible dream, that they build good lives wherever they end up. Your job is not to solve the housing crisis. That's for governments and policymakers. Your job is to help your own family navigate it as well as possible. And now you have the framework to do that. You know which cities offer genuine affordability combined with opportunity. You know what factors to consider. You know what questions to ask. You know what help you can provide safely and what risks to avoid. Take this knowledge, use it, share it, and know that you're doing something meaningful. You're helping create security and stability for the people you love. In an uncertain world, that matters more than almost anything else. So, take a breath. You've got this. Your family's got this. It won't be easy, but with the right information, the right support, and the right approach, home ownership is still achievable in Australia, just perhaps not in the places we once assumed it would be. And that's okay, because home is not a location. Home is where your people are, where you build your life, where you create memories and meaning. Whether that's in Brisbane or Adelaide or Perth or Newcastle or anywhere else, it can be a good home, a true home. Thank you for spending this time with me today. I hope this has given you clarity. I hope it's eased some of your worry, and I hope it's given you practical tools to help the people you care about. Remember, this has been general information only. Always seek personal financial advice for your specific situation. Now go forward with confidence. You have the knowledge, you have the framework, and most importantly, you have the love and commitment to help your family thrive. All the best.